Hey guys, welcome back to the channel. Today is Sunday, April 4th, 2021. Happy Easter. If you celebrate it, I hope you're having an awesome Easter Sunday. Okay, here's my real quick opportunity to say, look, I know a lot of people are watching these videos that are not subscribed because I see you. So please, if you're watching these videos and you enjoy them, please hit like and subscribe. Hit the bell notification so you can get updated when I release a new video on Sundays. I implore you, please. Secondly, I have kind of gotten away from what I intended to do with these videos, and that is keep them short and sweet. I mean, I have a tendency to just want to share too much. Like there's so much information out there that's not on your TV. It can only be found in the dark cracks of what they don't want you to see. So um, sometimes my videos run a lot longer than I intended. And I am going to make a committed effort starting today to change that. And how I'm going to do it is I'm going to have my wife set a timer, a 12-minute timer. And when that timer goes off, no matter where I am, I'm going to be forced to stop everything, bring it back to center, take some deep breaths, and give you the lowdown and wrap up the video so I can keep them shorter. So I'm making a commitment to that. She's going to set a timer, and then we're off to the races. So we'll see how this goes. Babe, are you ready?
Mm-hmm.
Okay. Go ahead and set the timer. Let it go.
Okay, it's set.
It started?
Mm-hmm.
Oh, it kind of gives me anxiety. We're off to the races. This little interesting article right here. Mortgage firms warn to prepare for a tidal wave of distress. Shocker. The real shocker is that, someone's actually reporting real facts. So this is a Bloomberg article. And if you scroll down just a little bit, you can see what the narrative is. Here it is. The Consumer Financial Protection Bureau warning is tied to forbearance relief that's allowed millions of borrowers to delay their mortgage payments due to the pandemic. To avoid what the Bureau called avoidable foreclosures when the relief lapses, mortgage servicers should start reaching out to affected homeowners now to advise them on ways they can modify their loans. Well, now, how in the heck are they going to modify those loans when the individual is still unemployed? I mean, mind you, our unemployment rate is still worse than it was at the very heart, at the very depth of the Great Depression. So there's a lot of people that are still very much unemployed, okay? And don't give me that, well, jobs are coming back, service sector is going to save the economy, because you're certainly wrong. But I'll get to that in a second. Anyways, it goes on in the article. There's a tidal wave of distressed homeowners who will need help, said Dave, someone whose last name I can't pronounce. Servicers who put struggling families first have nothing to fear from our oversight. But we will hold accountable those who cause harm to homeowners and families by doing their legally right and just measure of foreclosing on those homes. That's what he's really saying, right? It's like, hey, we're trying to scare you. Don't foreclose on a whole bunch of homes because we're going to come and get you in big trouble. That's what he's saying. It's ridiculous. Okay, let's move on because I hear a clock ticking in my head. Hey, look at this from CNBC. Critics slam the Fed as home prices rise at historic rates. Well, of course. Critics should be slamming the Fed because the Fed has done this, right? The Fed has built this huge asset bubble. And it's just one of many. And those bubbles are going to pop. And there isn't much they can do about it. So Why? Why are we blaming them? Are we blaming them for, lowering interest rates to all-time historic lows in order to spur growth in the housing market during this very tumultuous time? No. I mean, it's one of the reasons you could blame them. Here's another great reason to blame them. As of last week, the Federal Reserve held 2.2 trillion of agency mortgage-backed securities. 2.2 trillion. So I want to put that into context real quick. Guys, understand this. Just as recently as 2006, the Fed's entire balance sheet was less than $870 billion. Just back in 2006. It wasn't that long ago. I can remember. I still have clothes in my closet from 2006. Their entire balance sheet was less than 870 billion. But you know what the Fed's done since, let's say, March of 2020? The Fed has been purchasing mortgage-backed securities to the tune of $40 billion per month. $40 billion per month. Mortgage-backed securities. That's what the Fed's doing. It says it right here. Okay. Now they've got 2.2 trillion. And what happens? Let me ask you this. What happens when the Fed says, okay, it's time to scale this back? Even if they cut it in half. And they're saying, okay, next month we're only going to buy $20 billion worth of mortgage-backed securities. Well, that's gonna cause interest rates to spike, right? Certainly, everybody who's making investments, thinking that the Fed is going to be there, they're going to go, wait a minute. Oh, the Fed is recoiling now. Maybe we shouldn't be making all these purchases, right? Interest rates will skyrocket. So the Fed is going to have to curtail at some point. But I'm going on and on. I got to keep moving. So let's go on to the great news of the week. Here it is. Look at this. Jobs report blows past expectations as payrolls boom by 916,000 in March. Great. What does that mean? We got 916,000 new jobs almost? Oh, the people returning back to work. 916. Well, man, that's almost a million. That is outstanding news. BS. BS. Look, I'm no mathematician, but I know how to look at the real numbers. So I went right over here to initial unemployment claims for this month. Here's Saturday, March 6th. We were at 734,000 this month, last month. 734,000 for that week. Guess what happened the next week? It shot up, 765,000. By my math, we're already over a million, okay? What happened the next week? For the first time in over a year, new initial unemployment claims dropped below 700,000. It went down to 658,000. And man, you would have thought that, I'm surprised they didn't have a ticker tape parade to celebrate, because everybody was just saying, oh, what great news. Give me a break. Guess what? $719,000 last week. Like I said, I'm no mathematician, but if you add up all those numbers for this month, you're looking at 2.8 million plus. 2.8 million plus in new unemployment claims for the month of March. And yet here we are celebrating payrolls boom. Look at the verbiage they choose there, huh? Oh, it boomed. 916. Well, I'm certainly, you're building confidence in the market with articles like this, aren't you? And you're pulling the wool over the general public's eyes. That's what is happening. But before the timer goes off, let me bring it back to center. If I can figure it out. Oh, there I am. let me give you the lowdown. Guys, I do these videos because there's this false narrative out there. They're pushing so hard that everything's fine. Look at how we're rebounding. Look at the recovery. Like commerce is coming back. It's just not true. There is something coming. There is this. Damn it, I hate that. This is unsustainable. Okay, we're almost to the point where we can't even service our debt, and they're talking about trillions more in spending. Trillions more in a infrastructure bill. It just can't continue. At some point, the parent in the room has to say enough is enough. But there is no parent in Washington. And they know it. Like, I don't think these people are so dumb they don't know it. I think they're planning something else. So how are they going to deal with this if they just keep spending? What, you just print $28 trillion? Pay it off? Call it good? Why aren't we doing that? How about just print the taxes I owe you and call it good? In fact, all future taxes that I owe you, why don't you just print it? If printing is the answer, any future taxes I owe, just print that stuff. Now I don't have to pay taxes. Problem solved. I'm good with that. See, it's unsustainable. It doesn't make sense. I'm guessing there's going to be a currency reset. I'm not talking next year. Next 5 years? Maybe. Next 10 years? Oh, for sure. It's guaranteed. They're going to move to a digital currency. They're going to use inflation and all kinds of different things to reconcile this debt. But ultimately, believe me, it's coming out of your pocket. It's coming out of my pocket. It will. And they'll sell it. They'll find a way to sell it. Hey, look, it's digital currency. It's so much more convenient. Everything's easy. It's right there on my phone. We're not to the point where we're putting chips in our wrists yet. It's cleaner. You don't have to deal with that dirty cash, right? Look at me. I keep running on. I see I could do this for way too long. In the meantime, let cooler heads prevail and let's invest our money in real assets, things that can't just be, overnight disappear with the stock market. Let's invest in things like silver, tangible silver, gold. If Bitcoin's your thing, then Bitcoin's your thing. Okay, it's not mine, but hey, at least you're out of the system. So more power to you. Let's do some preparing. Let's buy, canned foods. Let's buy water. Let's improve the security on our homes. And that's all I got for you this week. Take care, guys. I'll see you next week.